What I think is really interesting is that if we look from September onwards and we look at the Brent Dubai swaps curve, right, it's in contango. So this poses an interesting question in terms of, both trading opportunities and how you see the market, because what the curve is telling us now is that Brent's premium will be rising against Dubai, and the question is why. Hello, and welcome to the second episode of Oil Insights. I'm your host, Harry Tchilinguirian, Group Head of Research here at Onyx Capital Group, and I'm joined today by Onyx Research Associates, Mita, Chaturvedi, and Vincent. Before we start the show, please like and subscribe to the podcast. I also invite you to visit Onyx LinkedIn and YouTube channels for more interesting and exciting content. The oil market started last week on a relatively strong note, only to finish on a whimper, trading in the sub-80s last Friday. October Brent, at the time of this recording, is trading around 79 and 10 cents. Geopolitics early last week did help uplift prices, with fund positioning ready to add some more risk, but geopolitical premia seemed to deflate as diplomatic efforts were stepped up to try to secure a ceasefire in Gaza. Now, positive economic news from the US, such as strong retail sale numbers, certainly helped to lift the mood, but the real macroeconomic focus was still on a string of weak data out of China. The hard data from China, such as industrial production, retail sales, and fixed asset investment, were all lackluster. The news was compounded by weaker crude runs in July in China, as well as weaker crude oil imports into the country. The weekly U.S. data from the EIA did not really help oil's cause, with the EIA showing crude stock builds against expectations of a large draw that had been fueled by the earlier preliminary numbers from the API. So when it comes to the shape of the curve on ICE Brent, the prompt backwardation has been roughly stable in the past week at circa 80 cents. There's no clear sign right now in the movement of the spread as to indicate a change in the relative supply of oil between today and tomorrow, it becoming looser or scarcer. So as we kick off the week, oil data out of China is once again at the forefront here today on Monday. China sharply reduced its exports of gasoline and diesel in July. And we're hearing that refiners are cutting runs due to weak export margins. So together with constraints related to export quotas out of China and weak domestic demand, China's refinery run rates for the end of this quarter and next are likely to be below initial expectations. So China's future crude demand, as well as that of the broader Asian region, is going to raise a lot of interesting questions around the evolution of Brent Dubai. And that spread we're going to be addressing in this podcast with Vincent. So forward Asian crude demand becomes even more important, given that OPEC may contemplate putting barrels back into the market in Q4. On the product side with Mita, well, we're going to see that refining margins are suffering, with flat prices in middle distillates and gasoline basically struggling. Last week, we examined gasoline, so this week we're going to be focusing on the middle of the barrel and looking at the prospects of gasoline. So to start off with, I'm going to be turning to Vincent and to give us a little bit of an update on the positioning on Brent Futures and what has happened since last week.
Sure. So positioning in Brent Futures has shown that money managers is getting longer week on week, but that's generally a function of them exiting their short positions rather than meaningful increases in long positions. In a sense, the market is just simply less bearish. That's because in the previous week's sell-off, where crude fell to lows around $75, we saw a large increase in short positions, and in the most recent week, money managers, their short positions in Brent and WTI declined by a staggering 28%, which is a very, very large amount.
Right. So in terms of risk capacity of money managers, it seems that they still have pretty much a lot of capacity for risk. What is the long-short ratio now? Is it still at the very low levels that we saw in the previous week?
Yes, relatively. So last week was extremely low, 1.1 to 1, and now it's increased to 1.5 to 1, which is still the third percentile for over the past decade. So relatively speaking, very, very short, and it's only been surpassed by weakness during the COVID times. And we think that it is incredibly, we're seeing a lot of variances in this ratio, probably because of increasing variance in short positioning as well. So there's more risk capacity for longs to enter, but not so much for shorts to come in, I think.
Right, right. So I think we're looking at a situation where, they could be dipping their toe in the market, but they certainly are not doing it. Mita, when it comes to CTAs more specifically, what is Onyx's own measure telling us about positioning?
So we're looking with CTA positioning right now, total net positioning across Brent, TI, gas oil, heating oil, and RBOB futures continues to be extremely short as per our CTA model, but things are improving. So we're currently sitting at just under negative 83,000 lots as of today, 19th August, but we did see a week-on-week increase in every single contract that I mentioned, except for RBOB futures. So RBOB specifically still remains really, the sentiment remains really low in gasoline, which saw a 22% decline this week to negative 15.9 thousand lots. On the other hand, positioning in Brent futures was up by 45% to, it's still negative, it's still at negative 26.7 thousand lots, but things have gotten better on a week-on-week basis.
But on the
Interestingly, though,
whole,
it's still net short, but as Vincent said, we are seeing people get less bearish, and that's what sort of helped price action. And that's been the case for through products as well. Interestingly, though, on a day-on-day basis, like just comparing today versus the end of last week, things have gotten shorter. They're still better than what we saw this time last Monday, but on a day-on-day basis, they have gotten shorter. So it'll be interesting to see whether we are on an uptick in terms of like, are things getting more positive, or was that just 1 week and are we going back to just bearish times?
so I mean that's an interesting question, and one that I ask both of you. Do you guys see a potential catalyst out there in order to sort of reinflate risk appetite? Is there something on the horizon that we could think about fundamentally or otherwise? Uh, Anything to spur on essentially bullish sentiment? Because with such positioning at record low levels of engagement, one has to think that on the first occasion, there may be a possibility there of beginning to, rather than pair the shorts, and start increasing the longs. So, guys, any thoughts in terms of what could help us?
I think the market is definitely waiting for an actual signal that there is demand for oil, or just any indication that there is going to be more consuming in a vital economy like the US. And that's why I think this week's Jackson Hole Symposium could be really important for sentiment. People are going to be looking up for what Jay Powell is going to say at his speech over there, and whether the way he's going to shape up the trajectory for interest rates in the US. I think that's going to be really important for sentiment. Um,
So we're waiting on Fed Chair Jerome Powell to come and save the day. Um, Otherwise, Vincent, do we have any other items that could help spur on risk appetite, other than, I guess, what is happening this week in terms of the Jackson Hole Symposium? Can we think of any other ones? Because I'm at a loss in terms of fundamentals. I mean, we had the forecast issued by the IEA and the OPEC Secretariat downgrading demand in the case of OPEC, sticking to a very bearish view in terms of the IEA. I think in order to spur some action, it's pretty difficult right now to identify an area of the world where there's a high probability of, say, a supply disruption. What do you think?
No, it is. It is quite difficult, and apart from the usual things that traders talk about for summer demand, for example, summer driving season, we haven't seen that, or refinery outages, we haven't seen much of that either. So that comes down to potentially extreme weather events or geopolitical risk. So even that, that's the geopolitical risk premium has been waning. That's Middle East, markets are waiting for the Iran's stated retaliation that has not come yet, although Ukraine's incursion into Kursk region of Russia has reminded the market that the geopolitical risk in that region still persists, and potentially, that might pave the way for further attacks on Russian energy infrastructure and potentially tit-for-tat attacks as well.
So we have a lot of firepower, and I guess basically people are keeping their powder dry right now, remaining on the sidelines. So it's interesting to see how Fed Chair Powell is going to address participants at the Jackson Hole Symposium, and whether or not he's going to specifically use this forum to give guidance in terms of policy. So obviously, a lot of people are expecting a rate cut in September. So from a risk appetite point of view, of course, that feeds in to an expectation. If he really wanted to get people going, he would go for the 50 basis point cut rather than the 25, although that's probably a very low probability right now. And then, as Vincent, you were saying, otherwise we're left with the usual suspects: event risk in terms of either weather or geopolitics, whereby perhaps what's happening in Ukraine is a little bit more interesting because it's a new development, whereas we sort of have a status quo, at least for now, and I don't know for how long, when it comes to the Middle East. Now, turning to crude oil developments, more specifically, Vincent, I wanted to talk to you about the Brent swaps market and pricing of differential and spread. So, as we said earlier, the ICE Brent contract, if you look over the past week and change, it's moved up and down, but in terms of ICE Brent spreads, we're looking at something that was trading in the order of 80 cents backwardation. How's the swap market pricing things? How are DFLs moving in the same direction?
Yeah, DFL still remain quite strong, although slightly weak compared to this time last week. So it's seen a huge, you can say, combination of short covering rally, as well as some trade houses and majors buying in the physical window. So that's driven up physical differentials, indicating a lot of demand in the spot market in the near term. But interestingly, this week we've seen the backwardation of the forward curve become less orderly, in the sense that October DFL has been the weak point. In our data, we've been seeing more selling flows from refiners and funds, whereas refiners have continued to buy in the more deferred, in the Cal 25s, as well as in September. So that seems to be a weak point in the curve, and we think maybe it's because of weaker freight rates. People might be expecting more flows to make more oil to make their way from US to the North Sea during that time, as well as perhaps a reflection of weaker demand from Asia as well, perhaps less Chinese buying, that sort of thing. So that's an interesting part to note.
Okay, well, continuing on our journey in swap crude oil differentials, something I was mentioning a little bit earlier, and that's Brent Dubai. We have a certain context for Brent Dubai, and we're now, I think, currently looking at Brent continuing to trade at a premium to Dubai. So what has been the recent evolution of the spread? Because it's certainly one that obviously is going to be dictating arbitrages of oil from the Atlantic Basin to the east, but also gives us a sort of sense of how the east is doing in general.
Yeah, that's an interesting one, because the Bow Org versus September Dubai spread, that's still around the contango range, which is so weak, indicating just a lack of demand for the Middle Eastern crude, whereas in Sep Oct, the backwardation has been almost as strong as the Brent Futures spreads. Interesting enough, when we're looking at the differential between Brent and Dubai, that premium has narrowed from like $1 a few weeks back down to around 50 to 60 cents at present. So that's come off quite a bit. We've seen the boxes also weaken to a contango. So these main sellers we've seen have been from both physical and financial, so trade houses, funds, refiners, and majors. So I guess it would be safe to say that, at least in the front, we're seeing in September, October, there's been better sentiment in Dubai crude, now that a lot of the dated stuff that Atlantic Basin crude has rallied. People have booked their arbs to fix their ships towards Asia, and now Dubai crude looks relatively cheaper, at least for the front months.
So it's interesting because when you start looking at Brent Dubai and you look at how much the Dubai structure has underperformed that of Brent. And as you were highlighting, perhaps the overperformance of Brent may have been due to certain plays in terms of the physical window, with people supporting the price and constantly buying into all the offers that were there, that led to this situation, and that's been coming off. Some of the froth in terms of the Brent market is coming off, and we've seen Brent's premium at least in the prompt relative to Dubai come down. What I think is really interesting is that if we look from September onwards, and we look at the Brent Dubai swaps curve, right, it's in contango. So this poses an interesting question in terms of, both trading opportunities and how you see the market, because what the curve is telling us now is that Brent's premium will be rising against Dubai, and the question is why. So we could think about relative strength for Brent that could come from geopolitical factors, with obviously the world's leading benchmark reflecting immediately geopolitical concerns. But I think, for me, it's still a case of Dubai weakness. And how could we explain this contango from a Dubai weakness perspective?
Yeah, so there's two main fundamental reasons. One is the weakness in demand out of Asia, so especially the bearish China narrative, for example, lower refinery run rates, less imports as well, and to top that off, the weaker than expected Chinese economic data from the last week just adds to the story, right? So if there's anything bullish, it won't be coming from China in the foreseeable future, unless there's some major things that indicate differently, but also because of the much anticipated OPEC plus bring barrels back to the market. Q4 is the expected start date, so the market is really on edge with the sort of thing. There's perhaps some expectation, if it's not Q4, will that be Q1, and that may be priced into this a weaker Dubai relative to Brent.
So we got, I guess, both a supply side and a demand side driven reason for Dubai's relative weakness to Brent leading to this contango. And personally, I only think that it could only increase. So being long Brent Dubai swaps, in my view anyway, for those who share our opinion, is not a bad position to have. In essence, there's an expectational element around China. And while the refiners may run a little bit lower, perhaps people are waiting for China to be restocking from an SPR perspective. On the other hand, the OPEC Plus has indicated, if market conditions are right, without actually specifying what these market conditions are, they would begin to place barrels back into the market. And the question is whether OPEC is prepared to place barrels back into the market if we're still living in a sub $80 per barrel environment. Which brings me really to our next section of this podcast, which is our poll. So this is something that we're reiterating this week. We talked about it last week, and we put out the poll again to ask our viewers and as to whether or not they thought, oil prices could sustain above 80 or should rather trade below 80. And we had a very, I guess, evenly divided result, with 49% of the viewers who responded indicating that Brent could trade above 80, and 51% who thought that it should trade below. So Vincent, last week, I think when I asked you this question, you were leaning more on the bullish camp and the above 80. Has your view changed since?
Yeah, no, it hasn't changed. I'm still in that same camp, and with the 49%, maybe it is time for a second referendum or second LinkedIn poll.
Maybe we should hold it again for next week.
Yeah. So actually, I would say short term still on the bearish side, but medium term still, I would still expect crude to hold above 80. Let's say, so everyone's looking forward towards the Jackson Hole symposium, whatever speech that Jay Powell's going to make, and from my perspective, I think that he's every single word that he says is going to be closely watched, and people are going to interpret his ways like.
That brings us back to the Greenspan days, where every little comma was even inspected in the actual transcript of the speech.
Yeah, or like learning English back in school, just like scrutinizing every sentence, what metaphors it might mean. But I think Jay Powell will not want to spook the market, and we do think that with the way things are going, there has been progress in inflation towards that 2% target. So perhaps a 25 bips cut is all but expected, and Jay Powell will talk about in a way to that will try to like calm and soothe the market. And
So you think this will get us back above 80?
get us back above 80, because then if there's a positive reaction, then people are going to be buying risk assets, right, which would give positive flows into crude and commodities.
So
as
you're
well.
looking for the risk sentiment raising, as the tide does, all boats.
Sure, yes.
So Mita, are you of the same opinion, or are you leaning more to the sub 80 side? And why?
I agree with a positive reaction coming out of the US and the Jackson Hole Symposium specifically. But I think in the more medium term, I think the OPEC barrels are a bit more tricky to comment on, because on one hand, more supply, just prices would go lower. But on the other hand, say they withhold that supply because market conditions aren't right. I think that itself is also a bearish indicator out there that prices, the conditions aren't okay. There is an excess supply that OPEC had to withhold these barrels. I think there's just a bit of like, I don't think they're winning with either decision over there. So I expect bearishness to come out of that. So I'm a little more bearish in the medium term.
Just to pile up on the bearish side is, and this is something we're going to look at with you, Mita, is, from a refining margin point of view, we're looking at the realized historical refining margins as having weakened quite considerably. We are talking about disappointing refinery runs out of China, even as they add more capacity to the refining basin in Q4. There's an element where, in terms of overall refinery utilization of this capacity, we may be falling short. So my question is really in a context where global oil demand balances suggest that the market's not in a position, given the growth in non-OPEC plus supply, to absorb an additional amount from OPEC itself. If you layer that on with if you will, an element of weakness in refining margins leading to further run cuts, then you have this sort of crude demand perspective saying, wait a minute, we don't need that much crude to satisfy demand, and perhaps that could take the complex lower. So very tricky. One, what the financial and risk appetite sentiment more broadly is going to do to prices, versus these fundamentals that are a little bit shaky, with the possibility of layering on a weaker crude demand to potentially extra barrels that come into the market from OPEC in Q4. Now, sticking with this idea of crude demand, and obviously it really depends on the profitability and the refining margins. So last week, in terms of products, we had a look at gasoline, and gasoline has disappointed this summer season. So we're going to move along the barrel to distillates, and here we're going to be taking a little bit closer look at what's happening in gas oil diesel. The economic picture, whether it's in China, whether it's in the United States, whether it's in Europe, especially Germany, is pretty bad. There's no other way of saying it. You look at this PMI data, you look at industrial production, it's all extremely weak. And so when you think about that, then industrial fuels such as diesel and fuel oil are obviously going to feel the brunt of that weakness. So have we seen this translated in the way that we look at the price evolutions in diesel, especially cracks? What has been happening?
No, I completely agree. And for example, with gasoline being so bad over the summer, diesel and gas oil specifically have been not doing the best for even longer than that. Say for a few bouts here and there, they've been pretty bearish since February or March of this year. So specifically looking at European gas oil, the ICE low sulfur gas oil, it's been on a persistent decline since earlier since last week. So that's since the 14th of August, based on both swaps and futures. Things have been on a persistent decline. We did see better sentiment early last week, but that's when Brent was also really high. Like everything was doing better with in terms of the futures benchmarks. They're all opened up higher, and that translated into better sentiment in the short term. But again, the fundamental picture is just not that great. Freight has been really low, and that's been really encouraging of inflows from Asia and the US specifically to get into Europe. And that's not been the best, because if you look at ICE gas oil structure right now, it's backwardated in the deferred term, but it's in contango in the prompt. So like the SEP Oct swap or the Oct NOV futures contract is in contango, and that's been, so there's a lot of incentive to just store these barrels, and with more exports coming in,
It's almost like Europe is a bit of a dumping ground.
yeah,
The
it
freight
really
is low.
is. It really is. Diesel exports from the US to Europe are expected to reach a record high in August, and that's all because it's also so, price is also so low in the US, and things with supplies being so ample everywhere and freight being so low, I think everyone's just looking to dump things elsewhere.
I think what's interesting is like if the cracks of diesel have been coming off, and you consider that against a background of weakness in crude prices that we've been experiencing recently, that means the product price is falling faster than the crude price, and that should be reflective of the underlying weakness in demand. So maybe from that point of view, Europe is one of those areas that sort of really concentrates that weakness, because when we start looking at regional differences in terms of the behavior of diesel prices, there are some prominent ones that emerge. And I think in terms of what's happening between East and West is an interesting spread to look at, right?
Yes, for sure. So syn gas oil in itself isn't doing all too well either. But for example, so earlier, so this was last week and the week before, the physical window was bid. We'd seen bids by majors and trade houses, which took syn gas oils up between around the 9th and 14th of August. Since then, there's been profit taking, general weakness, manufacturing data is not great, and syn gas oil has also come off. What's helping syn gas oil over Europe, though, with, as you mentioned, the East-West has been rallying. The East-West went from negative 26.25 on the 13th to negative 22 just earlier today. It's still looking strong. It's still looking supported, and a lot of that is because of hedging flow. So we're seeing combo buying, which entails buying the gas oil East-West and buying the syn regrade, which is a differential of synjet kerosene and versus syn gas oil. So that essentially is also what's deflating, just pressuring down ICE gas oil even more, because when you combo buy, you're essentially buying kerosene, synjet, and selling ICE gas oil. So that's also helped.
So we got two forces at play.
Yes, exactly.
Effectively.
So what's essentially happening because of that is the East-West is strong, regrade, that is, again, the differential between kerosene and syn gas oil is really strong, ICE gas oil is pressured even further. And yeah, so that, there you have it. That's
so
what's
we have a
happening
stronger
there.
East-West on gas oil, and I'm trying to think about what you were saying a little bit earlier, where when the freight is at levels that allow you to shift the surplus, it's with Europe being a structurally short diesel market, I suspect that they wouldn't be too unhappy to be able to have a bit more diesel coming their way. But it just seems to me that when you start looking at East-West rallying, you could argue that you're locking in spreads in order to shift surplus from one region to another, and perhaps as well. I mean, above and beyond what happens to China, and there's a lot of focus on China. It's not all bad in Asia. I mean, obviously there are some countries that are doing quite well, such as India, in terms of demand. But in essence, we have a very interesting development when it comes to diesel markets, with definitely cracks on gasoil diesel coming off. And if we're looking at where the center of gravity is and the center of pull is, if that's Europe, one would say that the current momentum is to still be short gasoline cracks in Northwest Europe.
For sure. Maybe in the medium term, with right now we've also, you mentioned India, and demand is still great, but things have been slightly more subdued just because monsoon and everything. And in a few months, we're going to see the Indian festival season, just better demand coming out of that region, which might ebb supply to Europe a bit. So that might help sentiment. But I agree, just I think it's still a good idea to just be short right
Okay.
now.
Well, I guess with that, that takes us almost to the end of our podcast. Do you guys have any final thoughts? So, in terms of everything that we said today, probably when it comes to crude differentials, Brent Dubai, definitely one to follow. My view is that there is definitely room, especially if OPEC does decide to reintroduce barrels, for that Brent Dubai forward premium to keep growing. And then when it comes to products, obviously a number of products are faring poorly, but when you think about diesel in particular, we're not at a point during the year where we get any usual seasonal uplift. So if Europe is the sink in which all the surplus is going to, holding short on barge cracks, I think, is not a bad solution either. Would you guys agree?
Mm,
Yeah.
yeah, I think so.
Well, with that, let's see if Fed Jay Powell saves the day at Jackson Hole. But in the meantime, thank you everybody for listening. And till our next episode, once again, don't forget to smash that like button and subscribe to our channel. Thank you very much, guys.